Welcome to my Accounting 1120 discussion on accounting for investments. I gave up the sordid goal of trying to do these pencasts late at night. For those of you that have an interest in a teacher's life, they came out dreadful. In keeping the first one, it was all right. Let's give the rest a go. They can be better, shall we? Let's come up with a goal for this pencast. My goal this morning is to review the accounting types of investments that we have available to us and to do a focus in this pencast on hold to maturity. I like to review each method as we go, as I think it helps you learn them well. So we'll do a quick review and then our focus will be on hold to maturity. The type of investments that we're going to look at in this chapter are trading, available for sale, hold to maturity, significant influence, and controlling influence. I realize that the accounting method in this slide-up is a little different than the book, but it makes more sense to me, so we'll proceed ahead. Our accounting method for trading and available for sale is an accounting technique called mark to market, where we write them up to market value at the end of the accounting period. Hold to maturity, used to amortize cost. Significant influence uses a method called the equity method, and controlling interest uses consolidation accounting. Good news is we're not going to talk about controlling interest anymore because that is the topic of an advanced accounting class. We'll just mention it so that you know what it is. How is it classified on the balance sheet? It's another good question. Trading, or are we short-term investments? Available for sale can be short-term or long-term, depending on management's intent, rather nebulous. Amortized costs are going to be recording the investment at cost, and if there's a premium or discount, amortizing it, as we learned in the last chapter. And significant influence is going to always be classified as long-term on the balance sheet. Finally, I want to look at what type of investments we're looking at. In trading and available for sale, they can both be stocks or bonds. The idea under trading is it's very short-term, as we mentioned, and you're only in it to take profit. Available for sale, it can be short-term or long-term, but you're in it for the profit. This can relate to stocks or bonds, but we're going to limit our discussion to stocks. Hold to maturity has to be bonds because there's a maturity date, and stock never has a maturity date. It goes into perpetuity. Cool word there, huh? And significant influence accounting only relates to stock. Remember, in order for this to kick on, your ownership has to be greater than 20 to 25% of the stock, of the common stock, so that you can vote it. And for controlling interest, it was greater than 50%, so you could control what a business was going to do. So we've looked at the type of investments, reviewed it, the accounting method used, how it's classified on the balance sheet, and what types of investments. Let's then move to hold to maturity and bonds. And you'll recall, in our example, the author has chosen to, and most gratefully for us, keep this discussion on par value. Let's delineate where we are here. We have our trading investments, and we have our available for sale, both using mark to market. And then we have our significant influence, which we're not going to play with right now, and our consolidation. So I'm going to focus my time in hold to maturity area. Let's start, as we do, with some facts. Are you ready? Here's our facts. we decide to invest in a bond with a face value of $10,000. It's a 10% bond, but it pays interest semi-annually, so each interest payment will be 5%. And we'll collect them on April 1st and October 1st. We purchased it on, we're going to go with April 1st. Silly me. Purchase this bond on April 1st. Let's do a little cash flow analysis of this bond. See where we are. So we buy this bond on April 1st, 2013, and it's going to pay interest on October 1st, and then on April 1st, and then on October 1st, and then on April 1st throughout the life of the bond. And each interest payment will be 10% cut in half to show it's semi-annual, so 5% of $10,000, or $500. So this bond is going to pay interest every 6 months at $500, and we're going to hold it to maturity. So the market value of the bond never counts. We bought it for 10, we bought it at par, and it's going to pay us par. We're going to receive interest payments on October and April 1st. But I want to put in the additional constraint that we have a December 31st year end, because that allows you to see the accrual entry at the end of the year to pick up any interest we haven't received. So first, let's record the purchase of the bond, shall we? At par value. Since we're investing, we're not issuing a bond. The debit is going to be to investment, hold to maturity for $10,000, and credit cash for $10,000. And you can see we have purchased the bond. And that would be on April 1st, 2013. Let's move out to our first interest payment now. When's our first interest payment? Our first interest payment is October 1st. So on October 1st, guess we should date that, we're going to get cash of $5,000 and pick up interest revenue for $5,000. And that shows you what it's like on our first interest payment. Then notice we get to year end. Is there an adjusting entry required? Well, you know that interest is earned with the passage of time, and October, November, and December have passed. So we have earned 3 months of the interest. We have not yet received it. It doesn't pay till April 1st. So we'll set up an interest receivable in the amount of $250 and interest revenue in the amount of $250. And then let's move out to April 1st, have another interest payment, but this time on April 1st, we'll collect our $500 cash. And what are the credits? Well, interest revenue is for the rest of that period, $250, but that doesn't make our journal entry balance. We need interest receivable to be taken down to zero because we have now picked up the amount we recorded at the end of the last year. How does that look on our 2013 income statement? Well, on our 2013 income statement, we should have interest revenue from April 1st, when we bought it, to December 31st. If I'm not mistaken, that's January, February, March is not included, but the other 9 months are. So we would have 3/4 of a year, or 3/4 of $1,000, and we do. We have $500 for that first interest payment, and $250 for the accrual. So interest on our income statement for 2013 should reflect $750. Let's move on to 2014. Let's copy over that first interest payment. Interest payment received on 4/1. We picked up cash of $500 because this bond pays interest, $500 every 6 months. We reduced interest receivable for the period October through December, and we picked up interest revenue for the 3 months, January, February, and March. Then we'll receive another interest payment on October 1st, of which point we'll receive cash of $500, and the whole thing will go into interest revenue because it all falls in one calendar year. Then we'll go to a 2014 year-end adjustment. And recall, we won't be receiving the cash, but we will have earned it. We will have earned interest receivable for November, well, really October, because we received our last payment October 1st, October, November, and December. Since it's a 6-month payment, it will be 3/6 of the $500, which is where we got the $250. We'll pick it up in interest revenue for $250, and that is a correct entry for our year-end adjustment in 2014. I want you to notice what's on our income statement for 2014. Let's post interest revenue. You know that's an income statement account. We picked up interest revenue on 4/1 for $250, and that was for January, February, and March. And then we picked up $500 on 10/1, and that was for the period April through October. And then we'll come in with our year-end adjustment that we make every year for October, November, and December. So after that first year, we'll be picking up a full year's interest because we will have earned a full year's interest. So after 2013, where we show only those 9 months because we bought it in October, from then on we'll show the full year. And the balance sheet's easy for the whole period, whether it's 2013, 14, or 15. We will have under the long-term investment category on the balance sheet an investment in hold-to-maturity bonds, whole running at $10,000. That will never change. This was an example done at par, as that is what our author chose to illustrate. If you had a discount or a premium, you would need to be amortizing that into interest revenue. If it's a short-term investment, they would let you do, or they would allow straight line, because it's going to be the short period of time that the investment is left, meaning the maturity date of the bond is coming right up. If it were a long-term bond with a maturity date way out there, you would be using the effective interest method of amortizing the premium of discount. Finally, remember, hold to maturity, R-E-M-E, boy spelling, huh? Hold to maturity are usually U-S-U-A, can't spell today, long-term investments, because bonds are long-term. But they can be short-term in the year they mature. So, that shall finish our discussion on bonds. And remember, we're investing in bonds. We're not issuing them in this chapter. Hey, thanks for joining me.